Cursor does about $2 billion of annual recurring revenue with roughly 50 employees. That's $40 million of revenue per person. Nothing in the history of software has done that. Lovable went from open beta to $100 million in reported ARR in 8 months. ElevenLabs ended last year near $350 million and crossed $500 million by May, $150 million of net new revenue in about 16 weeks. So building software has never been easier, or faster, or more valuable per head. And it has never been a worse business. I'm Big Z, and this is part 3 of 3. Part 1 showed the market prices what your revenue meter counts. Part 2 graded 5 megacaps on whether their meter is actually moving. This one asks the thing underneath both: if AI makes software easy to build, what happens to software as a business? The popular answer is displacement. AI-native startups eat the incumbents. That's the wrong frame, and the numbers say so. The real answer is arithmetic. And once you see it, AI kills SaaS stops meaning what everyone thinks it means. First, take the disruption seriously, because it's real. A voice product reached $500 million in reported recurring revenue in about 3 years, and is now used by 41% of the Fortune 500. A code editor reached $2 billion. An app builder went 0 to $100 million in 8 months and raised at a $6.6 billion valuation. None of these companies existed at scale 3 years ago. None of them needed a decade-long enterprise sales motion to get there. One honest caveat before we build on it: these are the survivors. There is no verified data on how many companies started in the same cohort and went to 0, so treat these as proof the ceiling moved, not proof the odds are good. Here's the number nobody puts on the pitch deck. Software at scale ran cost of goods of 10 to 25%. Gross margins of 75 to 90%. That single property, build once, sell infinitely, is what created the entire SaaS valuation model. AI-native software runs cost of goods of 40 to 50%. Gross margins of 50 to 60. Survey data from January put average AI product gross margin at 52%. That's improving. It was 41% in 2024, but it is not 80. Now the concrete version, and this is the sentence to remember: for every $1 million of AI product revenue, roughly $230,000 walks out the door as inference cost, before a single salary is paid. Every query spends real GPU time, memory bandwidth, and electricity. The marginal cost magic trick that built software as an asset class does not work on AI. The economics get worse when you look at retention. Benchmark data on AI subscription apps: they generate about 41% more revenue per customer, and they churn roughly 30% faster. Strong first-use moment, weak habit. That's consumer subscription data, so don't over-apply it. But combine it with what we just established and you get the shape of the whole layer: lower barriers to entry mean lower barriers for your competitor. The same tools that let Lovable reach $100 million in 8 months let 3 other teams clone the surface of it in a weekend. 52% gross margins don't fund a decade of enterprise sales moat building. And thin wrappers, the cohort with the least defensibility, run gross margins as low as 25%. The app layer is the easiest business in the world to start and one of the hardest to keep. Follow the money out of that inference line, because it lands somewhere specific. The 4 largest spenders, Amazon, Microsoft, Google and Meta, are putting roughly $725 billion into capital spending in 2026. That's up about 77% from roughly $410 billion in 2025. Amazon around $200 billion. Microsoft near $190. Google $175 to $185. Meta $115 to $135. And Nvidia captures roughly 90% of AI accelerator spend. Its data center revenue hit $75.2 billion in a single quarter, up 92%. By analyst decomposition, 55 to 60% of hyperscaler AI capex flows to Nvidia, 7 to 9 to AMD, 8 to 10 to Taiwan Semi for custom silicon, 6 to 8 to memory suppliers. That 23 cents of inference cost per revenue dollar? That's where it goes. And now watch this series close on itself. In part 1, the market punished the companies that bought AI and rewarded the ones that sold it. Alphabet raised capex and fell. Micron sold the memory and rose. Same thing here, one layer up. Meta raised capital spending without proportional revenue proof and the market took 6% off it. Meta is the one of the four with no public cloud to monetize, no meter to run the spending through. So the pattern holds at every level of this stack. Whoever's invoice grows with usage collects. Whoever's cost grows with usage pays. The app layer, structurally, is on the paying side. That is what 52% gross margins mean. So here's the reframe, and it's the whole point of these 3 episodes. AI Kills SaaS was never mainly about a startup replacing Salesforce. Very little verified displacement has actually happened. No public SaaS vendor has disclosed losing named revenue to a named AI application. What happened is worse, and permanent. The gross margin structure of the entire category reset downward. Software used to be the best business model ever invented because the second copy cost nothing. AI software costs something every single time it runs. A category that used to compound at 80% margins now compounds at 52%. That is not a disruption story. That is a repricing of an asset class, and it explains everything in part 1. When the market cut software's cash flow multiples to 2014 levels, it wasn't panicking about agents. It was marking down what $1 of software revenue is structurally worth. Now the practical problem, and it's a real one. Every company I opened this episode with is private. Cursor, Lovable, ElevenLabs, you cannot own any of them. OpenAI and Anthropic both confidentially filed with the SEC in June, both valued near $1 trillion at their last rounds. But be precise about what that is. A confidential filing is not a date, not a price, and not a guarantee. It's an option on a listing, nothing more. There are listed app layer proxies, Palantir, C3.ai, Upstart, UiPath, SoundHound. That's where valuation risk is highest, and several aren't profitable. So the honest answer is this: at the app layer, the winners are mostly unavailable and the available names are mostly not the winners. What is ownable at scale is the layer that gets paid regardless of which application wins, the accelerator and cloud complex, and, from part 1, the usage-metered software whose invoice grows with tokens rather than headcount. That's not a recommendation. It's just where the economics land. 3 things I'm tracking, and each one is checkable. 1. The gross margin line. The cohort average went 41, 45, 52 across 3 years. 60% is my threshold. Above it, AI software is a software business again and multiples can recover. Stuck in the 50s, it's a services business wearing software's old valuation. 2. Inference cost as a share of revenue. 23 cents per dollar today. If model prices keep falling faster than usage rises, that compresses and the whole layer re-rates. If usage outruns price declines, it doesn't. 3. The first real S1. When OpenAI or Anthropic actually prices a deal, the industry gets its first audited look at frontier AI unit economics. Every estimate in this episode is unaudited until that document exists. The strongest counter-argument to everything I just said. Inference costs are falling fast. If they keep falling, 52% becomes 65% and this entire margin argument dissolves, and the cohort average genuinely is improving, 4 points a year for 2 years running. And per employee productivity is a real, permanent gain. $40 million of revenue per person means you can run a 50% margin business with an org chart that costs a fraction of what Salesforce spends. Lower gross margin with radically lower operating cost can still produce a better operating margin. I don't think that's the base case yet, because nobody in this cohort has audited financials to prove it. But if you're bullish on the app layer, that's the argument, and it's a serious one. That was part 3 of 3. The series was called Software's Great Sorting. Part 1, the market isn't pricing AI resilience by category, it's pricing what your revenue meter counts. Seats shrink with AI. Compute and machines grow. Part 2, applied to the 5 condemned megacaps. For can show the meter moving. Workday can't. Part 3, the next generation of software doesn't have SaaS economics at all. 52% margins, 23 cents of every dollar to inference, and $725 billion in capex flowing to whoever owns the meter. One sentence for all 3, AI didn't kill software, it moved where software's profit gets collected, from the seat to the meter. Upstream, that's semiconductors and power. Downstream, it's every enterprise IT budget in America. If this series was useful, part 1 is the one to send someone. It's where the framework starts. I'm Big Z, follow me, see you in the next deep dive.